Hi, in the last video, we have modeled until the balance sheet and also the cash flow. Now in this video, we are going to model the balance sheet. So the balance sheet, what would you say? So balance sheet, you don't need to model by month because that's not really gonna make it effective. So the balance sheet we can model for year one and year two and then year three and then year four, right? So and then year five. So in the balance sheet, if you know, you already know the columns are, so the rows are fixed assets minus less depreciation net block. Then you have your current assets and you have your cash balance, right? And then you have your total assets. So the total will be the net block plus all the assets, and then that will be the formula. So we are just building up the model so that we can fill it up later. Is not that very complicated. The beautification we will do once we have finished everything so that it's easier for us. Then you have your current liabilities usually in the balance sheet, and you have your loans, and you have your capital investment, and you have your profits, right? Profit for the year. So this is how your balance sheet is going to look like, really. So let's now calculate these numbers. Easy. So the fixed assets, as we have seen our investment already, so you need to link it back to the year one, how much total investment we have done. The total, so we can calculate issues. So the our total investment was $9,000, $90,000, $80,000. Let's wait this way. So that we actually a little bit nice. Now we have done the fixed asset. Now what is the depreciation? So we have seen the depreciation in our income statement as well. We can use that. So year one depreciation was here. This is the depreciation for the year one. Depreciation is 9,600, and copy this. Then we can copy this as well. Now you get the net block. Oh, sorry. This is the additional investment actually. So the total investment is going to be the year one plus new investments. Then you have this gross block minus the balance sheet. You got numbers. Current assets. Now current assets, we have as I said in the previous video, we have assumed everything is sold cash, but that's not, that may not be the reality. Some members may not pay. You may have to do some loyalty program. You may have to sell. In a restaurant usually you will not have, but you may have some inventory, right? So let's say there is an inventory holding. So you, if you have taken my course on the ratio analysis, you will learn the inventory holding days. So we can calculate the inventory holding days. Let's say your policy is that you will hold at least 15 days worth of inventory. So 15 days, and then maybe the business as, so that is fixed, right? 15 days for every year. Or you may want to say, okay, maybe because it's a starting year, I may do 15 for the year one, and then maybe I will try to make it more efficient and reduce it to 12 and 11 here. So now how much inventory I should have? The formula for inventory holding days, if you remember, is average cost, total inventory divided by the average cost of sales. So what is average cost of, so means the inventory will be average cost of sales multiplied by the number of day holding days. So what is average cost of sales? Average cost of sales is in our income statement, have that here. Sorry, year one onwards, divide by 365. So this is our average cost of sale per day, and that will give us the inventory value. right? Multiply by, right? Now, when you are putting up the inventory, we have assumed in the cash flow, we didn't factor in the increase in current assets, so we have to increase in the current assets now. We have to say in less increase in current assets. Since we have only the yearlies, you can divide by 12 for each month so that you get the average number. Sorry, but on a yearly basis, you will get the same number. Sorry, yearly basis, you will get the same number. Then you can just follow that in the next year. Then the cash flow will be this minus this because our inventory is increasing. That's our cash flow is going to be. Our cash is going to be here. It may or may not tally together. Let's see how it comes out. Our cash flow at the end of the year is 9,758, and that's amount our cash flow. Yes, right. And then you normally will have current assets means your inventory basically. So that's your balance sheet. Now the current liabilities means you may not be able to pay your supplier. So again, the cost of sales means how many inventory days you are paying. Let's say you are getting a 30-day credit. So means the credit is 30 days credit supplies, current liabilities. And but on an average, you are holding around 40 days because you pay 10 days later from the end of the month. You're holding 40 days worth of cost of sales. So your current liabilities will be the average, the holding day of the current trade payable is also the same. Trade payables divided by the average cost of sales. So we can use this. Again, we have a same thing to do. We need to adjust our cash flow model here again because decrease, increase, minus. So it will be actually a minus. So we can use this here so that we don't have formula again. Increase in working capital liabilities. Usually you can always also do by taking a net working capital. We are not using that here for the time being. Then we follow the same formula. Cash is adjusted, current liabilities are adjusted. See if is going to tally already. Loans, how much loan we have set, how much loan we are lending pending with. So the loan outstanding amount you can take from here, year one, or you can take it from the capex line where we have actually calculated the investment here, total loan required. So the year one, our loan is actually it's not amount. So I can put up the amount here, right? And the formula is correct. So 65,000 we have taken, and then the plus because we have to do the year to date. We have to add whatever in the year two is, and now we get it. Okay. So we have actually returned our money outstanding. So this is at the end. Then the initial capital was fixed, so it's gonna be 10,000. Anyways, $10,000 initial investment and the profit. So profit will be coming from income statement, net profit. Let's see that year one, how much year one? Yes, here. Yeah, year one is only $6,000. So it doesn't tell you. Wrong. Oops. Yeah, my mistake. I think the cash flow was not correct. So that's a test, acid test um, for our balance because this is at the end of the year. So we cannot actually combine it together like this because net for that year, but in a way is correct. Year one is minus 80,000, net is 11,000. So does the balance sheet is tally? Yes, this balance sheet is tallied. So we can check balance sheet is tallied. Sorry, minus this. So first balance sheet is tallied. The other balance sheets are not getting tallied. So we find out the reason why it's not getting tallied, right? So there is a change. Let's see what is the difference. Or we wrong in our profit and loss statement? Hmm, no. So it's most likely the cash flow is going to be the impacting us. So the number of change is 1,000 plus 11,000 because that is the balance. Then 11 14 plus 11 and then 25 plus 56 and then 56 plus 57. So 37,000. Why the, oh, sorry, my mistake. The cash, the profit is going to be accumulative. So it means this is going to be plus of this amount. Yes. So now is only 57,000. Aha, the cash is similar. Let's see if they're doing still the same mistake or not. Hmm, there seems to be similar mistake here because the depreciation is also only for 1 year, so it will be accumulative. So the net value is going to be different, and the current liabilities are also should be only the change. Let's see how we are going to fix it. So we have to fix it. Let me show you in the next video once I have fixed, and I will tell you the mistake.